This has been a busy earnings week where just yesterday after the market closed we heard from both Microsoft and Meta. Do check out our earlier episode if you want to see how that went. But today we're focusing on McDonald's that just reported minutes ago. And we also want to flag here that the market yesterday was fairly flat, not too much movement right across the board. However, today in the pre-market, we are seeing a large sign of a very strong movement from many companies. Nvidia up nearly 5%. We also have Microsoft reported their earnings as highlighted up 9%. And we do believe this will drive the market up even higher. So do expect a very strong day, or at least into the open. But today we want to bring your attention back to McDonald's. Now we are seeing in the pre-market they are down around 1 to 2%. Bear in mind the company has been strong over the last 12 months, up 17%. Year to date they're up double digit, 10%. And over the last 10 years, if you have been a shareholder, you would have outperformed the S&P up 225%. And we do also notice it is trading towards the upper end of the 52-week range, with just one buy rating at the moment from Wall Street, a forward valuation around the 26 mark, and a forward yield of 2.21%. Both of which we will shortly show you against the 5-year average. And before we just talk about their earnings, we want to highlight we do get a fairly polarized view from analysts on the company. We have Barclays, who earlier in the year did give this company a $347 price target, giving overweight status. We also had other analysts who not that long ago did turn McDonald's into a buy rating, and even Wells Fargo, who actually said in Q1 this is the top choice in their view for a company to hold. But if we talk straight into the numbers, it doesn't look that great, although you probably wouldn't be surprised given the economic climate, and even those who are used to the company, their prices seem to be increasing even higher, and it's no longer looked at one of those places where you can go for a relatively cheap meal. In fact, their revenue from the same quarter last year down 3%, their bottom line net income down 3%, as well as their earnings per share. Now the main thing that we're going to discuss today is their revenue, which is down around 3%. That is quite a substantial miss. And their earnings per share, although when we will take a look at other metrics, they have seemed to come in pretty much in line. And maybe one of the key takeaways to consider with this company is that they've just reported the largest US same-store sales decline since 2020. Not great at all. In fact, that is down 3.6%. And one of the key reasons here is the more cautious consumer. As we highlighted, maybe in previous periods, this would have been a company that would have thrived in a very poor economic climate where consumers would have gone for low-cost meals. But now that isn't the case. That is shown in the numbers. And as we said, their worst drop since the 9% that we did see in the second quarter of 2020. And when we take a look at a bit more detail behind the figures, analysts were only anticipating a decline of 1.7% for the first quarter. So yes, they were in agreement. They were anticipating a small drop. But as we said, 3.6, even worse than analyst expectations. And when we take a look at the actual figures, again, EPS will be slightly different depending on which analyst you look at, but it is pretty much in line or a marginal beat. 267, expectation 266. But the main point here is they have missed, and fairly substantially, on the revenue, 5.96 billion, expectation of 6.09, bearing in mind the expectation already incorporated a drop of nearly 2%. In terms of their bottom line income as well, 1.87 billion, which is also a decrease to the same quarter last year at 1.93 billion. And the CFO, like many that we have heard in this earnings period, has put some of the blame, in fact, onto these tariffs, onto the pricing concerns for consumers, believing that they are getting a little bit worried, at least in the shorter term, and are starting to cut back on some of their costs. Again, McDonald's, perhaps for the majority of people, not a place it used to be given the vast increases we have seen in their pricing, but something that we have heard consistently from them, at least in the last few quarters, where in fact their performance hasn't been that strong. They're continuing to look into more value meals, more cheaper alternatives to increase the footfall that isn't just where management wants it to be. In terms of expectations though for the full year, and perhaps why we aren't seeing a larger drop, they have reiterated their full year outlook where they're anticipating the opening of 2,200 new stores, and that for the full year they're anticipating the total sales growth to be in the 2 to 3% region. Now look, it isn't a great look given the fact that right now is definitely a different period to the pandemic, where in fact the majority of their stores where it closed or consumers were more cautious about going outside. But right now, the narrative that is being sold by McDonald's management is that these tariffs are knocking consumer confidence, something that we also heard in PepsiCo's latest earnings, where they said consumers are in fact getting anxious and they're cutting back on snacks. And not just PepsiCo, again, we can note from the earnings call of Chipotle and Procter & Gamble, this is becoming a fairly large issue. And we can also see their quarterly same-store sales percentage change. It hasn't in fact been that great over the last 4 quarters. Only one of them we actually saw growth, and very minimal at that. But as we can highlight here, this is the large drop since Q2 of 2020. Now, over the next 3 quarters in 2025, they are still expecting growth to the earnings per share. And we also notice when we look at Q1, where we saw a marginal beat, out of the last 5 quarters, in fact, they have outperformed on only 2 of them. So they only have a 40% track record. And if you're someone that likes to look towards the next full accounting period, based on December 2026, they are trading at a valuation of 24. And actually comparing their current forward P of 25.9 against their 5-year average, they are pretty much in line, and the same to be said on the yield at 2.21 versus the 5-year of 2.28. So based on these 2 signals at this moment in time, we would say McDonald's does look to be reasonably valued. And that is the same conclusion when we take a look at this blue tunnel, which indicates the expected fair price. Right now, we do see it in the mid to upper point. So again, reasonable signal is in fact noted. But remember, we will also run it through our own valuation process shortly to give you our own opinion. Now, they do get an F on the valuation grade. Main reason, the sector does trade a lot lower at 14.5, meaning you're paying an 80% premium for the company against the sector. Is it worth it? That is something to consider, and no matter what valuation metric you look at against the sector, this company as a whole is pretty much trading at a very high premium. However, if we do compare it to their 5-year average, it is trading at a very marginal discount throughout the majority of the metrics. So you need to ask yourself 2 things. 1, does McDonald's deserve a premium to the sector? If your answer is yes, then the next question is, how much of a premium does it deserve? Again, we'll go through that in the valuation. But one thing is for certain, their growth or lack of is not impressive at all with a D+. Revenue year on year at 2% and forward looking at 3%, very low, but not that far off the sector, which is also low single digit. And whilst their 5-year average isn't that much better, it is still marginally higher at 4% and 5% respectively. But when we look towards the future, analysts expect EPS growth over the next 3 to 5 years at 7.7%. That is lower than both sector comparative at 11% and their own 5-year at 9%. So do you believe it is worth a premium? It is pretty much increasing its revenue alongside the sector, but actually EPS growth is a little bit lower. But what does make this company stand out is their profitability, where they get an A+. Gross margin 57%, well above the sector at 39%, above their own 5-year at 55%. Bottom line 32%, well above the sector at 4%, and also above their 5-year of 30%. So we are noticing efficiencies from the company. They are improving their margins, whilst also generating more cash from operations. 9.5 billion above the 5-year at 8.2, and significantly above the sector at 285 million. So quick recap for this part of the analysis: just 1 buy rating from Wall Street, F on valuation, D+ on growth, and an A+ on profitability. Now, what are the institutions doing with 70% ownership? 9 billion worth of selling over the last year, but a lot more buying at 15 during the same time frame. And we can also highlight in the most recent quarter, Q1 FY25, 1.5 billion worth of buying, 390 million worth of selling. So institutions clearly and still very bullish on the company overall. In terms of insider ownership, well, 0.25%, 23 million worth of selling over the last year. In Q2, around 300,000 worth of selling. In Q1, 8.9 million. And whilst we do always like to remind you that insider selling isn't typically a bearish signal because they sell for many reasons, personal and financial, we will show you the sells if you want to incorporate it in your own thesis. 23rd of April, an insider sold just under 1,000 shares, netting them $300,000. Again, information is here for the other sales during the period. And as we consistently like to show you super investors, when we take a look at McDonald's Corporation, whilst we don't have all of them come through, especially the likes of Bill Gates, Warren Buffett, and Bill Ackman, we can in fact see some have come through, although one we did notice did buy just 3 shares, so very, very trivial. If we look towards the previous quarter, in fact, we can see the Bill and Melinda Gates Foundation adding around 335,000 shares. Very, very trivial in terms of the overall percentage. And as we said, make sure you're subscribed so you are notified when we get some changes from the more popular investors. Now we'll also quickly run through the quality of the company. Dividend safety does sit at 77. We run through these two reasonable signals, and they did in fact increase the dividend in the most recent period, 6% September 2024. And if we take a look at the safety score reaffirmed a few months ago, it is safe, which ultimately means a dividend cut for the company is in fact unlikely. Now, key metrics from the 07-09 Great Recession: they increased the dividend, didn't cut it, didn't maintain it, negative 6% sales, well above the average of the S&P, negative 12, and one of the best recession returns we have in fact seen, negative 3% when the S&P itself was negative 55. In terms of dividend growth as well, not too bad, 6% most recent year, 7.5% over the last 5 and the last 10 years on average. And if we do take a look at the company, they've been increasing these dividends for the last 48 consecutive years, meaning they're 2 years away now from becoming a dividend king. We'll then move on to the free cash flow payout, important for dividend paying companies. And as always, earnings data is here if you want to see, but we tend to ignore as it is susceptible to manipulation by management through accounting. Below 50% for the restaurant industry, just to give us faith, they can increase it at a very attractive rate. Very inconsistent and always pretty much above. Over the next 12 months, expected 69%, but given that has pretty much been the norm over the period, we would anticipate another increase this September at around the 5 to 10% level. And then we get to free cash flow per share, not too bad, although we would want to see more consistent growth over the period, nearly double over the last 10 years, and an increase anticipated over the next 12 months. Then we get to the sales growth, which isn't looking too great, and also bear in mind in the next full year they're expecting growth of 2 to 3%. What we don't like about that is typically inflation is on average at 4%, so if they're not getting that at a bare minimum, then ultimately they're not keeping up in line with inflation. And shares outstanding, as always, we love it when companies return excess cash to investor pockets through share buybacks, something they've done, although it has started to slow down over the most recent period, so maybe not something that is taking priority in terms of management's capital allocation. And speaking of such, return on invested capital, we want a minimum of 12% to give us faith management can effectively allocate their capital. Looking very strong over the last 10 years, sitting at 19% now for a few years as well, so that is a good sign to see. And then we move on to the margins, where ideally we want to see increasing year on year. That is exactly what we get, not only well above the minimum 16%, but we're noting efficiencies 29 to 46%, and free cash flow very, very strong, well above the 5%, 26 in 2024, a definite free cash flow machine. Finally, the net debt to EBITDA below 3.5 for restaurants. Bear in mind, below numbers reflect the number of years it would take the company to pay off all of their debt net of cash on hand, correlating to balance sheet strength, dividend safety. 3.33, ideally we want to see it lower, and that is what we are anticipating over the next 12 months, but definitely something we would say just to keep your eye on. And then if we compare their performance against others in the industry, we have Starbucks, DoorDash, as well as some very well-known other companies in the sector. They're up around 20%, bearing in mind reinvesting dividends. One of the better performers out of the bunch. Then when we expand to over the last 5 years, we can in fact see it again sitting there around the top 3, up 91%. And when we expand to over the last 10 years, one of the best, if not the best, up 319%. So it does look good over the longer term, but always important to understand that past performance is not an indicator of the future. And if we do the same against the S&P, well, they're up 20% over the last 12 months, outperforming with the S&P up nearly 11, expanding to over the last 5 years, pretty much both fairly even around the 91% mark, but over the last 10 years, that is where we truly see that outperformance, 318 versus 163. Question is, do you believe they can continue to outperform over the longer term, or whatever your investment time horizon may be? Just before we get into the valuation, we want to let you know we have released our latest free weekly article. We drop on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a copy we have just released this morning with severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our intrinsic value for MCD today comes to $305, purely the average of these three models that you see on screen. Now we'll run through each one so you can see how we got to the conclusion, but we have the multiples valuation model, P of a few companies in a similar sector and size, the EPS of MCD to give us our first undervaluation signal, although you could argue fairly minimal. Remember though, we're not looking at any one of these models in pure isolation. Then we have the dividend discount model, where we have the dividends year on year, fairly decent in terms of growth, 7.24% on average. Moving forwards, we want a little bit more conservative, 5.75 below the average, below the current increase, giving us another marginal undervaluation signal. And then we end on the DCF model, free cash flow year on year, growth rate moving forwards 11%, with a discount rate giving us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 259 giving us our first overvaluation signal, 305 then the average of these three. And remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for McDonald's or any others. Now typically what we would do is we'd run through the MOS, margin of safety, where we'd use 10%, execute on that if it meets our three golden criteria, which would be a wide moat, strong financial metrics, and good forward-looking data. But right now, what we're saying is the company we believe is trading at a little bit of a premium. But for those that did want to see at a 10% MOS, a buy at 275, at 15 at 260, at 20 at 244, and at 25% 229. Having said that, Wall Street on average do have a $330 price target, which in turn gives this upside of 5%. As always though, give us your thoughts. Do you believe MCD, McDonald's right now, is a buy, hold or sell? Are you surprised with their earnings? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.